Hey, welcome back to POA for you. It's Leroy again, and today we are gonna go through 2022 O Levels Paper 2 Question 3, and the topic is on inventory. Now, if you got a friend who you think can benefit from this video, please share it with them. It's a free resource for everyone. Now, without further ado, let's go and check out what we have today. Alright, let's see what we have here. Okay, so Luna has a business selling footwear, and for the end of the financial year, the ending inventory, she's reduced the value of it from 61,000 to 59,000, and that's because of a water leak. Now, they've asked us to do a double entry for this. Now, straight away, you know that the one leg of the double entry would be related to inventory, because inventory value has gone from 61 to 59,000, and therefore it's gone down. Inventory is an asset account, and asset accounts are debit in nature, so any reduction would be credited to the asset account, which in this case is inventory, and is debited to this account called impairment loss or for inventory. Now, this is an expense account. So if you think about it, you've got inventory of 61,000, and then it's now valued at 59,000 because there are $2,000 worth of inventory that's just damaged, right? So this amount of inventory that you bought for the purpose of selling is now, you can't do anything about it, right? You're writing it off, right? So this would go into an expense because this becomes a cost of doing business for you. Okay, so that's where impairment loss for inventory is an expense account. Expense accounts are debit in nature, so I'm recording a higher expense as a result of this water leak, and therefore I debit it. Okay, so part B. What is the double entry for making an insurance claim? So the question is saying that, hey, Luna, after the year end, realized that I bought insurance and I could make a claim against the insurance for this loss of inventory. So what still stays true is that the inventory value went down from 61,000 to 59,000 because of the water leak. Now, so crediting inventory is still correct, but you did not have to debit impairment loss for inventory because that wouldn't be an expense to you anymore because you got insurance to cover for it. All right, so you right away, you know that the first journal entry to correct this is you have to credit impairment loss for inventory to offset this two. So these two will now net off to zero, right? Because debit 2,250 and then credit 2,250, it nets to zero. And what do you debit? That's the thing. When you're making a claim from insurance and the insurance hasn't paid you yet, that means the insurance company owes you money. It's not trade receivables because it didn't occur as a result of buying and selling inventory. It's other receivables. Okay, so it's other receivables, a claim from insurance. Now, why do I debit this? Because this other receivables is an asset, and to record an increase in the asset, you debit it. Right? Now, part C. Name and explain an accounting theory, the accounting theory that's applied by the business when accounting for a reduction in the value of inventory. So what was the accounting theory behind making this reduction in inventory value? So there's a whole list of accounting theories. If you haven't seen my video on all the list of accounting theories, please go and take a look. It's a very good and quick summary of that. But for this, it's prudence. And what does prudent mean in this case? Let's take a look. Yeah, the asset value should not be overstated. So any asset that you have in the statement of financial performance or position should not be overstated, and it should be valued at cost, which is the cost of what you buy, or the net realizable value, whichever is lower. Okay, and that's saying that, hey, if you think that the asset you bought is $100 and you think you can sell it for $200, you're not going to value the asset at $200. You're still going to value it at $100 because that is the lower of cost or realizable value. And now, why do we do this? Because since the inventory, this is a bit of explanation here, value is lower after the damage, so the reduction in the inventory value is therefore recorded. Okay. Now, the next part of the question, it tells you some information about cost of sales and ending inventory, and tells you to calculate the days sales in inventory for year ended 31st January. So what is days sales of inventory? So days sales of inventory would give you ultimately a number that tells you it's 30 days or 60 days or 40 days, right? And these number of days would represent how much the inventory amount in would last you to support your sales in the future, right? So it's an estimate basically. And let's see what the formula is. The formula is here you go. Average inventory, so average of both periods divided by the cost of sales for the year and multiply by 365 days. Your end result in this case, you would get apply the formula accordingly. So 50 plus 59 divided by 2 divided by 326 times 365, you get 61 days. And 61 days, you are essentially saying that 59,000 worth of inventory should be able to support about 61 days of your sales going forward. Okay. Now let's look at the next question. The next question is the question tells us that the days sales in inventory for 2020 and 2021 is 45 days and 52 days respectively, and they've asked us to comment on the trend over the 3 years. So 45, 52, and the latest one is 61. So you see that days is getting higher, right? So your inventory balance can support, it used to support only 45 days of sales, then now it's, and then 1 year later 52 days, and now it supports 61. So you're holding more and more inventory that you perhaps you may or may not need it, right? So let's see what I prepared for you. Essentially it has increased over the years, right? That's one observation. And what does that mean? It may mean that, hey, with the inventory balance right now, it may take more days to sell those on hand, and therefore because inventory, you've used cash to buy the inventory, so you're kind of locking up your cash there, and it would reduce your liquidity of the business. Okay. The next statement I've also prepared is the possible reasons for why inventory days sales in inventory has increased over the years is as follows, right? So it could be, maybe you have a supply issue. Maybe you've anticipated that your supplier told you that, hey, they're going to temporarily shut down, so you need to buy more inventory, so that when they are temporarily shut down, when they are shut down temporarily, you don't run into an out of stock situation. Or maybe your suppliers changed its policy to say that, hey, before you could buy inventory, the shoes, the footwear in quantities of 10. Now they say, oh, the minimum purchase is you have to buy 100 shoes, or otherwise I won't sell you, right? So it could be one of the reasons. That's why they are holding more inventory at year end. Or it could be because they anticipated, I was going to sell a lot, but then because of some reason, whether it's competition, whether it's because of poor forecasting, or the consumers didn't react much to the campaign that you had, you didn't sell as much, and therefore if you don't sell as much as you anticipated, you'll be left with inventory. Then the other one could be just you don't have an inventory management system, right? You don't anticipate, you don't place your orders based on what your anticipated demand is. You got no clarity on the anticipated demand. You just place it based on, I don't know, historical trends, and historical trends may not represent what's going to happen in the future. Okay. So suggest 2 ways where you could improve the efficiency of managing inventory. So the first one that I put in here is implement an integrated demand planning system, whereby your orders are based on reliable sales forecast that takes into account the what's happening in your promotional campaign, what's happening in the competitive landscape and stuff like that. Okay. And then the other one is you could also review alternative suppliers to see whether you can start to buy from different suppliers at a lower order quantity or a shorter lead time. So lower order quantity would help, right? Because if right now your supplier is asking you to buy only in multiples of 100 pairs of shoes, but if you're only selling, like, I don't know, 40 pairs of shoes a month, then that's a bit too much. right? So if someone would be able to sell you at a lower order quantity, that would be great. Or if someone could sell you at deliver very quickly, like their shop is just beside yours versus their shop is based in Europe where the delivery is longer, you would therefore hold lesser inventory as well. Okay. All right. So I hope that was helpful for you. That's a bit for now. And if you have any questions, please feel free to let me know. Otherwise, take care and good luck.